So, if you haven't heard, there is quite a lot of panic at the crypto disco, and people are worried that their investments or their trades are going to go south, and that they're going to start losing some of their tasty gains because they think the market is going to suddenly go down the tubes. I would argue that many of these people saying this either don't have the experience to understand how markets operate, or they're foolish and haven't learned the lessons from previous times when people got all panicky, or they're misleading people or misinforming people or deceiving people for one reason or another. Usually because they're grifting or shilling something. I'll tell you, FUD is one of the great many ways that helps traders get wrecked. What do I mean by that? Well, FUD, which of course, if you don't know, stands for fear, uncertainty, and doubt. FUD is one of the ways that people make mistakes on their trading positions. They will panic and get out of positions. Usually what they'll do, the majority of people anyway, is after they've bought a top, because they got hyped in by FOMO, which is of course the fear of missing out, FOMO, right? Most people don't trade well, of course, so what they do is they buy tops and they sell bottoms, right? And that's how they provide liquidity to the rest of us who buy bottoms and sell tops. So, how is it to positions like this? Well, if they bought a top, say they bought some time between March and May, or even a couple weeks ago, when the prices were anywhere from 56 on the low side to 73 on the high side, and most of them bought in the higher half of that, between 66 and 73. Well, what happens is, hello, hey doggy, hey buddy, oh, you're a cute one, you're a good one, hello, hi, you okay? You're a happy dog. You're a happy dog. What a beautiful happy dog. What a beautiful happy dog you are. Yes, you are. Interruptions by animals. It happens. Some beautiful golden retriever just came and said hello, and now a very friendly cat is saying hello. Why am I greeting animals? Well, they greet me, so I may as well greet them. So anyway, people, let's say in the last couple of months, on Bitcoin or whatever asset you want to look at, that had recently nice runs to the upside back in January, February, March, and even before that, going back to like September of last year, right? A lot of crypto had nice moves from September of last year. Things started to pick up quite nicely again. But it also had a good year in general last year, right? Right. So since September last year until March of this year, we've seen some nice moves up. And then from mid-March, things kind of went sideways. Well, all that really is sell pressure, buy pressure, sell pressure, buy pressure, being pretty much in equilibrium, right? In some kind of stasis. And that's really good for low time frame scalpers and other people who want to accumulate at relatively stable prices. Right? It's a great period for accumulation. And what have we seen in this period of time? We've seen a great deal of accumulation. Right? As I've mentioned many times, since January alone, when the ETFs went online, and really it's been at an accelerating rate. We've seen companies like BlackRock and Citadel and State Street, etc., Grayscale, whatever, all accumulating significant, copious amounts of Bitcoin, right? Together, the top ETFs, the US-based ETFs, have accumulated more than 1 million Bitcoin just since January. Like, they hold more than 1 million of them. And yes, they also hold hedging positions to those holdings, which means whenever there's a slip differential, a delta if you will, a movement to one side or the other that makes one of their trades more profitable than the other, meaning their spot hold versus their short on futures, right? They just cash out some portion at the same exact time on both ends, close the trade on both ends, and cash out the difference, right? Cash and carry. And they do that, and then what they do, obviously, is they buy back when the price is lower, and they sell more when the price is higher, right? And that's really what any normal, trading firm will do if they know what they're doing and they have the capital to do that and the computer power to run arbitrage trades at the exact same time on both ends of the deal. Meaning they can close both sides of their trade at the same time, right, with their respective counterparties. So what you have is a situation where the market in general had been FOMOing in for, more than a year, right? A year and a few months, plus minus. And you can say, well, last summer it was pretty still. Last summer, actually, there was some pretty significant movements. I know people like to say June, July, August are quiet. But if you actually look at June, July, and August of last year, there were definitely very tradable days. And I believe it was last year even, was it July? It was like a 20% movement or something. Like, if you just look at the monthly candle. Of course, it was a lot more if you add up the dailies and all that and everything else, right? But the candle, I think, for July was around 22%. Pretty significant, right? But anyway, that doesn't even matter. But the point is, from January of 2023 until March of this year, prices of things have basically been going to the upside with some sideways bits here and there, but generally speaking to the upside, right? Well, that's normal. Whenever you get big legs up, you're going to have some sideways. Why? Because the volatility is going to reset. The entropy is going to reset. Right? Things are going to reset. They don't have to, but they usually do. Why? Because once you have significant movement and there's a flood of interest and a fusion of liquidity into the market trying to catch the tail of that comet, usually they've missed it, but they're trying, and they usually get in near the top. And then as soon as it starts to go the other way, they start to panic, and they sell when it gets to the bottom because they hold on, thinking, no, it's going to go back up again. I know it is. I have a feeling. Yeah, I don't know if you heard that interruption, but anyway. All right, so the sideways, and I've spoken about this in recent weeks, that is the thing that will drive people nuts, right? That's where the shakeout will happen. You have a lot of people who will basically give up their positions. They'll lose the positions because of the sideways, which is really nothing more than a kind of equal. And that's, if anything, the best time to be trading, if you ask me. Especially if you're trying to accumulate. Because if you're trying to accumulate, you can do that in trades on low time frames when it's going sideways. And if you have a trading account position, it doesn't cost you additional capital to win a trade. It just takes time for you to run the trade and then take your profit. And if you run low time frame trades, you just run fast trades and you accumulate on every win. And then you'll say, yeah, but what if it goes down in price? Okay, well, so it depends on your goals. If you want to have more cash available, or if you want to have more of the asset you're trading for available, right? Maybe you cash out some part of your gains. Maybe you keep it all in the asset. Maybe you cash out all of it. Depends on your goals. Can you know for certain if the market's going to go one way or the other? You can have a really good idea if you know how to read the VEPs, at least for what's going to happen very likely today. And you could have a really good idea what's going to happen further out, of course, because you got projections and things like the RMLRs and the PB2 and the PB1, right? We know how to look into the future with our VEPs tools, and it's remarkably accurate. Does that mean you know exactly where the price is going to be 3 days, 3 weeks, 3 months, 3 years from now? No, of course not. You don't need to. You need to have a general understanding of the broad picture of the market to know that whatever the market is, generally speaking, if it's a liquid market, the assets over time generally will go up in price because of drift, right? Drift is the natural tendency, or the tendency, for price to slowly go up over time, right? That drift can actually be not so slow. It can be fairly significant. But generally speaking, drift is the tendency of price to go up over time. Now, there's many reasons for that. Right? One of the things that causes drift: more printing of dollars and yen and euros and pounds, shekels and guilders. Do they still have guilders? Pesos, whatever. Right? The more governments keep printing their currency, the less value it has, the less purchasing power it has, and therefore the more expensive or the higher the price on things are. Even though you might argue it's less expensive, it just costs more of that number, but that number has less purchasing power. So, if you increase the supply by, say, 5% supply of currency, but the price of the asset only goes up by 3% or 4%, well then, you've decreased your purchasing power by more than you've increased your number on price on the asset, right? So there's a difference. It's not always perfectly matched. Of course it's not. Right? It can't always be perfectly matched. Prices go up and down on both sides of the assets continuously, right? This purchasing power of the dollar goes up and down, up and down, up and down, but generally it's falling down because they keep printing more of it. The same thing goes for any fiat that they keep printing more of. Purchasing price or purchasing power of a commodity like Bitcoin or many other commodities generally goes up in value over time. Not because there's necessarily less and less and less of it over time that's available, right? In fact, sometimes we keep discovering more and more of something. And you might say, well, yes, you're discovering more, but there's still only a finite supply available on Earth. Okay, that's true. But until we're anywhere near that finite supply, we're still in discovery mode in terms of figuring out how much there actually is, right? Like gold and diamonds, for example. We're still discovering how much there actually is, because they keep discovering more, you know, and mining more of it. And they only release a tiny amount every year onto the market in both of those cases. You know, it's quite known, for example, the De Beers cartel controls the diamond industry, and they release about 1% of what they have, you know, that they have stored in vaults every year. And they keep adding more to it every year, and they're adding more to it at a rate that is higher than 1%. So the inflation rate of diamonds is actually much more than 1%, but they only release, you know, an inflation rate that affects the market at a rate of 1%, so that they have a completely controlled market, so that they can inflate the value of the diamonds and sell them for, you know, whatever price they want to, right? Which is, if you want to talk about a monopolistic, you know, antitrust abuse, you could certainly say that that is a candidate for regulatory oversight. Not that I particularly care, but I mean, it's not particularly great that an industry where at the lower level and middle level it runs on the word of a person, right? It's completely based on trust. If you don't have a good word, if you don't have good trust, people don't trust you, you're out of business. If they trust you, you know, you're flush with cash. That's how it works in the diamond business. And that's in some ways great, in some ways not so great. Because what if somebody spreads rumors or lies about you that aren't true? I'm sure that's happened. But even if not, you know, on the one hand, you got the lower level and middle level people operating on trust. So for them, their word matters. But at the higher level, at the cartel directorate level, the syndicate level, where they control the entire industry, it's not trust. It's antitrust. They're abusing their privilege as a monopoly to exploit the market in ways that are, you know, anti-capitalist, right? Completely profit-driven. They don't care about the average consumer at all. They don't care about delivering the best product for the best price. And you can say, well, diamonds are great products. Well, if you, okay, you want to think so, then sure. It's just a piece of carbon. And they're plentiful. And they're definitely way overpriced. Okay? It's a matter of like, it's just purely perception. Because the value of a piece of carbon, which is the most common element in the universe, shouldn't exactly be so high when we pay so much less for other elements. But that's what it is. You know, it's hard. It's the hardest element. Great. That doesn't make it the most valuable one. Anyway, so the point is, people get wrecked when markets go sideways. As I've been warning about, we would see an increase in the transfer of wealth from the haves and the have-nots, because people who fear sideways markets will panic sell, especially once prices dip. And we're already seeing it, and prices have barely dipped. Right now they're like 11% from the top. Now, can you say, well, if it's about the short, I should sell? Yeah, of course you should sell before it shorts, before it falls. But most people won't do that. They'll hang on. And then when it falls 20, 30, 40%, you know, then they'll think about selling. Maybe in crypto, they wait till it gets to 50, 60, 70%. And they get so badly hurt, you know, that if they're not already wrecked by that time, then they'll sell when they're at complete loss, or practically a complete loss. Anyway, so, wow, cool. Hey, how you doing, folks? Good to see you. So, don't, if you're trading, you know, don't just react emotionally with panic, fear, uncertainty, and doubt. What you should do is trade low time volatility, entropy, probability, and statistics. And once again, if you want to know how to do that, just go to the Alpha Trading Discord. It's completely free to learn all this stuff. We're not interested in selling you anything. You know, if you even ask for our pro traders premium indicators, we're just going to tell you no. Like, we don't want anybody buying that unless they actually know how to trade volatility, and we'll know who knows to trade volatility. We certainly can tell. You know, what you do is you go to the Discord and you get the indicators that we give for free, and you learn with our free indicators, our free chart, our free tutorials, our free videos, our free everything, free live streams, free chats. And it's all free. You get a free education, and you get free indicators to boot, which people use to actually trade and make money. And we wouldn't give them away if we didn't use them ourselves. So just go to alphatradinghq.com, click on the Discord link, or just go to alphatradinghq.com/Discord. And you can just create a request support ticket in the request support channel, and just ask for the free trial. The free volatility starter pack. That's not a trial. It's permanent indicators. You can have them permanently as long as you're in the Discord. You know, as long as you don't quit the Discord, you have access to those tools and access to all the educational resources and everything else. So once again, and for the last time, alphatradinghq.com/Discord. And that's it for now. I'll see you all there. See you all in the next video. Hopefully give it a thumbs up or something. And I'll talk to you guys later. Happy trading.